Manishi Raychaudhuri, CEO of Emmer Capital. He joins us right now on the show to talk about his thoughts on how the markets move ahead, maybe. And a bit we'll get in Kush Bora as well to talk about the technicals. Manishi, great having you. Thanks so much for taking the time out. Are you surprised by the strength of the uptick in Indian markets despite disruptions, both internal and external, non-market, of course, geopolitical, but disruptions and the ease with which the Indian markets bounce back through all of those?
Let me point it out this way, that I'm surprised by the buoyancy in the entire Asian market, in its entirety. We have major indices like MSCI Asia ex-Japan trading at about 14 to 15 times P multiple right now, about 1.6 times price to book, which are in line with their long-term averages. MSCI Asia ex-Japan has moved up about 14 to 15% this year, just in the first 6 months, which is extremely surprising given the extent of uncertainty that we have had. Geopolitically, we have had acceleration in military conflicts in the Middle East. We just had a brief spike in oil prices, nothing much more than that. We have had extreme degree of policy uncertainty as far as trade policy and tariffs are concerned. But the market seems to be climbing several walls of worries consistently. And that comes as a surprise to me. Along with that, as you rightly point out, India has also done well, though India has actually underperformed this year. Asia ex-Japan is up about 14%. India is up about 6.7% if you look at Sensex or Nifty. And that just in local currencies. In US dollar terms, it's slightly lower. So, yes, while Indian performance has been surprising, I think Asian performance, particularly North Asia, markets like Hong Kong or Korea, have provided a bigger positive surprise.
Good morning, Tamanna here. Just taking that forward, you're saying compared to a Japan or a Hong Kong, Indian markets have actually underperformed. Does that imply that there's more room to go? That, we're just getting started after climbing all those walls of worry after, I think, about 4 months of uncertainty?
Right. In fact, I would say been about 6 months of uncertainty, right? From September last year to somewhere around March or April. Indian markets bottomed out in around late March, and there was another leg downwards right after the Liberation Day worries. Liberation Day tariffs were announced. Now, despite all this, India still remains overvalued, and that is, one bugbear that the market has suffered from. Currently, the one-year forward P multiple is about 23 times. That compares to somewhere around 19 times the long-term average. The current premium that India trades at compared to Asia ex-Japan is about 55%. That's stupendous. The usual long-term average premium is about 40%. India always trades at a premium, as it should. It's a high-growth market after all, but not at the kind of premium that it has been trading of late. So, in a nutshell, what I'm trying to say is that, yes, India has underperformed a bit. Maybe there could be some more underperformance on the cards in the near to medium term, which would bring the relative valuations closer to the averages. We were there in late March, and then India bounced back again. I would also point out another worrying factor about India, which is the earnings trajectory. Earnings estimates continue to keep falling. They have declined about 6 to 7% if you look at consensus EPS estimates for 2025 or 2026. So we need two things to happen. Number one, we need earnings stability. We need earnings to flatten out and then the estimates to begin increasing. And we also need a certain degree of relative valuation correction, which makes the market palatable for both domestic and international investors.
Manishi, hi, Alex here. Just on that last point on the earnings trajectory, I'm just wondering if certain things have not been factored in into those projections which might force them higher. And here I'm talking about the last action by the Monetary Policy Authority, by the Reserve Bank of India, to cut rates by 50 basis points. There's anticipation of another 25 basis points, possibly bringing the repo rate further lower. I'm just wondering, because that's going to play out over the course of 3 to 4 to 5 months. And if you include the infusion of liquidity that has already taken place and the CRR cut, which is a cash reserve ratio cut, which kicks off in September, then you're talking about multiple cylinders that will be firing over the course of the couple of quarters that come through. Right. So do you think that that's positive tailwinds and people will have to revise their estimates upwards?
Undoubtedly. No, that's a very important point to make. You know, that that jumbo rate cut that RBI did, and simultaneously the cut to CRR, those are surprises to the market, and they would play out over a time period, you know, maybe over the next couple of quarters and beyond. So yes, I would actually expect the earnings estimates to kind of flatten out over the next one quarter and maybe begin some nascent rise, maybe in the last quarter of this calendar year, which is the second half of the fiscal year. But as I said, that after all, in this market, seeing is believing. You know, when you see those earnings estimates, being raised, that's when I think the degree of confidence, especially from the foreign investors, that'll come back in a big way. Now, there's an interesting point about this RBI rate cut also. I published a detailed article on this recently on Reuters. And basically, yes, I mean, it's been a major surprise to the market. But given the fact that the indicators like GST collection or e-way bills, they were already indicating a healthy economy, why did the Reserve Bank of India need to do this? And, one indicator which could indicate some degree of hidden stress is the kind of debt that households are accumulating. If you look at household debt to GDP ratio, just 2 or 3 years ago, it was 36%. Now it's up to about 42%. As we all know from RBI data, that credit card loans have been skyrocketing. Mm-hmm. So I think, RBI was trying to balance the positives and the risks to household consumption.
Manishi, before we let you go very quickly, from what the RBI has done, where we're poised right now, do you think BFSI is the sector to bet on as far as India is concerned?
I would think so. Okay. BFSI, banking in particular, has been one of our favorite sectors in India, and particularly private banks. As I've been saying, even on your channel repeatedly, that if India is to grow at about, maybe 12, 14% as far as corporate top line is concerned, and about 10 to 11% on nominal GDP, that growth in consumption and investments would have to be financed by the banks. And it's the private sector banks which are gaining market share on account of their reach and their superior technical capabilities.
Okay.
So they also have way better asset quality.